Broadcast is now starting. All attendees are in listen-only mode.
Hello everybody, welcome to join our Let's Learn Futures series webinar, and this Futures and Derivative Webinars is an educational initiative brought to you by Bursa, Malaysia and organized by us, Live Champ. Okay, and today we are very excited to bring to you a very renowned speaker, a very famous author, to talk about the introductions to futures concepts. So this is one of the elementary or preliminary class for you to understand what exactly are futures concept and how is it different from the stock market. Okay, and before we begin, just want to check if you can hear my voice. So if you can hear me, please go to the control panel and click raise the hand button. If you can hear me and see my screen and see our speaker on the line, please click raise the hand button. All right, click raise the hand button if you can hear me clearly. Let me see. Oh, hi everybody. I am seeing your hands right now. Thank you so much. You may put down your hands now. Thank you. You may put down your hands. Yeah, my name is Shane Chu. I'm the host for this webinar. So before we begin, just want to talk about a disclaimer. So whatever we share in this webinar is only for educational purpose. In nowhere that we give you any buy or sell call for any futures contract. So if you decide to long or short any futures contract, you do it at your own risk. Okay. So the presenter or nor me nor Bursa Malaysia will take any responsibility for your own financial decisions. Okay. So now, as usual, every year we prepare a lot of derivative content and also share investment content for you. And this is our derivatives webinar. We have a whole structured derivative webinar prepared for you. Last month we talked about trading techniques. We talked about spread trading, and this month we're going to talk about introductions to future concept. And then next month we have Malay webinar that will talk about pengenalan kepada konsep niaga hadapan. Okay, so and then we have a whole lot more of futures derivative webinar that are designed to empower you or to understand derivative, how you can use it to your trading and meet your financial objective. Okay, now, so if you complete the whole series, you will be a very savvy futures trader. Now, allow me to introduce the speaker for today, and I'm very honored to be able to invite her to share with you the idea of futures trading. And she is none other than Pauline Yong. Okay, hi Pauline, thank you so much for tuning in.
Hi.
Yeah, she is the
Thank you for having me.
Yeah, correct. Allow me to introduce yourself. So, she is the managing director of Sigma Wealth, and she is a CFP and a licensed financial planner with Securities Commission, and also a bank Negara. She has been in this training industry for more than 20 years, so is an industry veteran that I look up to. She was an economy lecturer for 16 years, and now she is the course facilitator for the FPAM CP courses. She has published 5 investment books and financial planning books, and she's a very famous author and she writes regularly. She is a speaker with a big heart. She writes to share her knowledge with many people as through her articles in magazines and newspaper, and also as a regular guest on the City Plus FM radio for the stock market outlook. Okay, so she's also a member of Society of Technical Analysis of UK, and also the CFTE, Certified Financial Technicians, if I'm not mistaken. Okay, now without further ado, let me hand it over the session to you, Pauline.
Hi. Thank you for having me. Today, my session here is about introduction to the futures trading concept. So, can you hear me?
Yes,
Okay.
we can hear you loud and clear.
All right.
Now,
okay. So, yeah.
We are seeing your screen now.
All right.
Excellent.
Okay. Let me go back to my screen.
We are seeing your screen now.
You are seeing my. Okay.
Yeah, I'm seeing your screen.
So yeah, so this is today the 1 hour webinar. This is a content for today. I will first talk about the background of about our Bursa Malaysia derivatives, and then what is the future contract, and what are the types of futures contract, and who are the market participants, and why do we trade futures, and the order types, and also the case studies. So a lot of us, we are very familiar with buying into the stock market. We can own a share like Public Bank, Maybank, or CIMB Bank. And then however, when it comes to trading futures, right, people are thinking that futures trading is it very risky, and then some of them they even try to avoid having into the trading into the futures market. So I hope that today with this 1 hour introductory webinar on the futures trading, you will have a different look about this trading industry. And then perhaps you can start opening account and to have a try on the futures market. So for our Malaysia, we have 2 exchanges. And the one that I said just now about buying into the stock market, the public bank shares or CIMB bank shares, that one is buying into the Bursa Malaysia stock exchange market. So for the futures trading, we have another exchange is called the Bursa Malaysia derivatives. So the Bursa Malaysia derivatives, the word derivatives comes from the word derived demand. So whatever options or futures listed in this Bursa market, derivatives market, is actually a derived demand. So what that means is that these listing, right, they are actually having an underlying commodities or financial instruments. So don't worry about it. Later when I go through and I'll explain further into details. So for Bursa Malaysia derivatives, it's owned by 75% is owned by our Bursa Malaysia Berhad, and 25% is actually owned by Chicago Mercantile Exchange. And one thing we are very proud of our Bursa Malaysia derivative market is that our FCPO is the most liquid and successful crude palm oil futures contract in the world. So the pricing that's set in our BMD here is actually the benchmark for the world crude palm oil price. Okay. So what is a futures contract? Futures contract are standardized legal agreements obligating buyer or seller to buy or sell a commodity financial instrument at a future date and an agreed upon price. So what does that mean? So it means that you have a buyer and a seller entering into a contract. And then this contract will have a specified the date, a future date, and then the price for the underlying commodities or the financial instrument. So let me, there are different types of, I will illustrate further. There are different types of futures contract. So we have basically we have financial futures, and this includes the stocks, the indices, and the interest rates. The most common are the indices. The other one is the commodity futures. So for these commodity futures, we have crude palm oil, we have crude oil, gold, silver, soybean, and things like that. So these are the options and futures that are traded in our Bursa Malaysia derivatives market. So we have an extensive list over here. The gold futures, the palm oil, the index futures, the interest rate, and also the options. So among these, right, the most liquid or the most popular ones are the crude palm oil futures. And the next one is our FKLI, which is our KLCI futures. So this one, the underlying will be the crude palm oil. The product is crude palm oil. And then for the KLCI futures, it will be our Bursa, our KLCI index, which is comprised of top 30 largest cap stock in Malaysia. Okay, so this KLCI futures will be comprised of our top 30. So now recently in last year, October 2018, we have a new product come, which is the Bursa Malaysia 70 futures, FM70. So this one is actually to go hand in hand along with the KLCI futures. So what that means is that this is based on top 30 largest cap stocks, whereas this one, the index is based on the next 50 top largest cap stocks in Malaysia. So this is comprised of mid-cap stocks. Okay, mid-cap stock. So and it is gaining popular. Of course, the most common is the crude palm oil. Okay, so what is a standardized contract? So this is a standardized contract that consists of the contract size, the contract month, the trading hours, and the minimum ticks. So for example, we have the KLCI futures contract. So, okay, the KLCI futures contract, the contract code is FKLI. So in short, we will say FKLI. So that's referred to our KLCI futures contract. And then the underlying instrument will be our KLCI index. Okay. And the contract size is our KLCI multiplied by 50 ringgit. So if let's say our KLCI index is 1,700 points, so that will be 1700 times 50 ringgit. Okay. Then the minimum price fluctuation or the minimum tick or the minimum price fluctuation is the 0.5 index point value at 25 ringgit. So if any movement about 1 index point will be 50 ringgit. Okay, so then the trading hour is 8:45 to 12:45. The second trading session will be 2:30 to 5:15. So our derivative market operate at a different operation hour than our stock market. So you need to adjust that. So which is 15 minutes earlier and 15 minutes later than our equity market. Then next we come to, and just now the contract price is actually 4,000 ringgit per contract. So if you are looking at to buy one contract, the price is 4,000 ringgit per contract. So the next one is our crude palm oil futures contract, which is also 4,000 ringgit per contract, and the code is called FCPO. Okay, so in short, people usually say FCPO, FCPO, and then the other one is called FKLI, FKLI. So we refer to these two most popular contracts. And the underlying instrument is the crude palm oil. Okay, the contract size is 25 metric tons, which is 25,000 kilograms. That's a lot. And the minimum price fluctuation is 1 ringgit per metric ton. So that means when the price move up by 1 ringgit, it will be 25 ringgit for your futures contract. The trading hour will be also 2 sessions, but it starts at 10:30. So it starts at a later time than our stock market. So it's 10:30 to 12:30, and then however, it also ends late, which is 2:30 till 6 p.m. Okay. Okay. Next, we come to the market participants. So when we are into this futures market, we want to know who are the market participants. So the first one is the hedgers. So the hedgers refer to those people who has already owned an underlying position in that particular commodity. So for example, you are the palm oil producer. So for a palm oil producer, you will have harvest your crop. So your crop will be your palm oil seeds. So you want to sell it. So however, if you plant now and then months later or 1 year later, then you want to sell it, you do not know what will be the price later, because the commodity, as you know, the commodity price is always fluctuating. So in order to protect yourself, protect your position, so this palm oil producer will enter into a contract, a sell contract. That means they will short the market. They will short the FCPO. So that means they have to this particular application, this price, specific price at a specific date of delivery. Okay, so they will enter into a selling hedge to protect against their selling price. Okay, so when it comes to the buying hedge, who are the people that will buy the futures contract for this hedging purpose? So in this case will be the palm oil refinery. Okay, so for example, if you are the palm oil refinery, so a palm oil refinery will need to buy the raw material, and the raw material will be the palm oil seeds, for example. So you need to buy the palm oil seeds from the palm oil producers. So then you will need to enter into a buy contract. That means you lock in your buy price. So in a future date, at this specific date, at this specific time, then you can buy at exactly this price. So is it beneficial? Yes, beneficial to both parties. So for the sellers, you can protect your selling price. And then for the buyers, you can actually protect your buying cost. So actually, this is a win-win situation for both parties because they are hedging against their position. Okay. Then we come to the speculators. So who are the speculators? All of us, okay, me, you, everybody else in the that we do not own any underlying position, because for us, we just merely trying to profit from this futures market by using our fundamental analysis and our technical analysis to try to take advantage of these price fluctuations. So we are the speculators. So is this with risk? Yes, this is with considerable amount of risk. Okay. Then the next market participants are the arbitrageurs. So the arbitrageurs are the ones that try to profit the price misalignments in different markets. So the keywords is different markets. So that means you have, let's say you sell Apple in market A, and then there's also another place where you sell, there's another market for Apple for in place B. So the two markets, they have a price difference. So the arbitrager will buy from one market and sell to the other market to profit from the price difference. So this is arbitrage. So for our Bursa Malaysia, the only example that I can think of is at settlement. So at the settlement price, when you see that there's some differences in the price, the spot price and the settlement price, maybe you can take advantage of that. But however, that one you need to come up with a lot of cash to buy the contract. So, and is this with risk, with low risk or no risk? Because there's a secure market out there already. Okay, so physical delivery. So when you are in this futures market, right, you will heard about physical delivery. So this physical delivery concerns who? Okay, is it concerns the buyer of the contract or concerns the seller of the contract? What do you think? I give you 3 seconds to think about physical delivery. Okay, so when you see that this delivery, it means deliver to you. So who are the people who would receive something? The buyer or the seller? Yes, the buyer. Okay, so if you are the buyer of if you long a contract, that means you buy one contract. So at the end of the expiry date, and then if you do not sell it, that means you are obligating to buy this particular commodities from another party. Okay, so however, in our futures market, usually our brokerage firm will, before the delivery date, they will ask you to sell or to close your position because they do not want to deliver this kind of physical goods. Is too complicated. Okay, so this is physical delivery. So if let's say you are the seller, then you have the obligation to deliver this, sell this product to the other party. Okay. The next one, we talk about some futures trading terminologies. So the most common that we can see is long means buy, and then short means sell. Okay, long is buy, and then short means sell. So this is simple, right? However, the next one, people always confuse bid price and offer price. Okay, so you see this bid price starts with the letter B. So I always ask my students to remember, if it's B, you remember buy. Okay, so bid price is equal to the buy price, the price at which the buyer is willing to pay for the contract. So always remember the bid price is the buy price because it's a B there. Then the other one obviously will be the sell price. Offer price is the selling price. Okay, then we have the market price, which is the spot price or the current price of the contract. Then the settlement price. This settlement price is calculated by the Bursa. So it is actually the average price of the contract throughout the day. So this settlement price is actually available half an hour later of the closing, the market close. Half an hour later, then the settlement price will appear. And usually this settlement price is to calculate the margin position, okay, the accounts for the margin. Okay, the next one is the initial margin. So this initial margin is the amount of money required to initiate a buy or a sell position. So for example, if the contract is 4,000 ringgit for one contract, so the initial margin will be 4,000 ringgit. Okay, then the maintenance margin is the minimum amount of equity required to hold the position of that contract is initiated. So for the beginning, the maintenance margin is also equal to the initial margin, which is also 4,000. However, your broker will ask you to top up a bit more to prevent the next one, what we call is a margin call. Because very often when you enter into a contract, right, if the price does not move according to your prediction, if you long a contract, you are expecting it to move higher. However, it moved the other way around. So if it moved the other way around, that means your position, you will have a negative position. So then you will come into this margin call. Okay, so this margin call. So in order to avoid margin call, usually the broker will ask you to top up a bit more. So if you are looking at to trade one contract 4,000 ringgit, so probably you will have to top up like 5,000 or 6,000 ringgit, so that you don't get trigger the margin call so frequently. Then you have the value per tick. So the dollar value affect the smallest unit move in the futures price. So just now we saw that the per tick is 1 ringgit and 25 ringgit for the crude palm oil, and then it's also 25 ringgit for the FKLI. Okay. Okay, so next, just now we talk about the long and the short. So when it is long, it means to buy. So when would you want to long a contract? It's when you think that the price will go up. So usually you will have an entry price over here, and then you have a target profit. Okay, so this one you have to based on technical analysis. Usually for traders, you have to know technical analysis. So you enter a entry price, and then you set a target profit, and then at the same time you also set a stop loss. So from the diagram here, you can see that the target profit and the stop loss is about 3-to-1 ratio. So this 3-to-1 ratio, we also call it the risk reward ratio. So reward to risk ratio, it will be covered by another trainer in another video on the risk management. So however, there is no right or wrong way, because sometimes, although the textbook tells you it's 3-to-1, however, when you do the real trading, depends on the product, depends on the market participants, environment, this thing can be changing. Okay. Okay, the short sell. Short sell means when you're expecting the price to go down. So when you short sell means you short at a certain price, and then you will set the target below the price. Okay, so that will be your profit at below the price, and then your stop loss will be above it. Okay, so this is the basic understanding about long and short before you can enter into the to trade into the futures market. Okay, the next one is volume and the open interest. A lot of people, when we invest in the stock market, we are very familiar with volume. But however, when it comes to the futures market, then we see a new word, which is the open interest. So what is open interest? Okay, so first of all, the volume is the number of contracts traded in a day. So this is the daily volume. So each trading day, the volume starts over at 0. So this is very simple, right? However, what is an open interest? Open interest is the number of contracts that have been created that are open. So the key word is open. Okay, so that means when you buy a contract, you long a contract. Then in order to close a contract, you will short. That means you will sell it. So buy to open a contract, and then when you close a position, you will sell it. Okay, so that's a close a position. So a lot of people, they explain this using Mr. A do this, and then Mr. B come in, and then Mr. C. Very complicated. So the way I explain it will be you focus on yourself. Okay, you focus on yourself, and then let's say if you long a contract. So when you long a contract, the volume increase. Okay, you long a contract, then the volume increase. Then the open interest also increase because it's an open position, correct? Then, okay, let's say you see that you have already made money, so you close the position. So when you close the position, you sell the futures. So you sell the futures, the volume also increase because it's a sales done. However, for this open interest, is it still open? No, because you close the position. So this open interest will reduce. That means you close the position, so it will reduce by one contract. Okay, so you can see that for this open interest, the keyword is also interest. Interest meaning that if you are still interested in this futures contract, you will still having an open position. However, when you decided to close it, that means maybe you are not interested in it anymore. So why you are closing the position? There could be a few reasons. First, is it because you are making money? Okay, if you hit your target profit, then you close the position. I'm not interested in this anymore. I want to go. Then number two, is it because the expiry date is nearing? Then you need to go before the expiry date is near. Then that means you want to leave. That means you are not interested in this anymore. You close the position. Okay, then number three, is it because the trend has changed and then it has moved against your forecast trend, and then you want to stop loss, so you close the position. You are not interested in this anymore. So you can see that whenever you close a position, the word is that you may not be interested in this contract anymore. So this brings us to the next one, where we will see that this volume is actually to verify the liquidity of the commodity, whereas the open interest is to use to gauge the strength of the trend. So in order to test your understanding, let's go to the next slide. So which one have strength? So for example, if let's say we say that the price, okay, the price go up and the volume also go up, okay, then the open interest go up. Is this contract, this particular month contract, is it has it got strength? Yes, it has. It has strength. That means that a lot of people are very interested in this month's contract, and then a lot of open position. Okay, that's very good. Then, however, when the next example over here, when the price go up, and then the volume come down, open interest also come down. So when you see open interest come down, it means what? People not interested. People are leaving this contract. So this particular month's contract, not interested. Okay. So is this got strength? No. Okay. So this one, no strength, not enough strength. So the next one, when the price go down, okay, it's a very bear market. Let's say it's a after election bear market, or everybody short. Okay, then the volume go up, open interest also up. Okay, because everybody think that it will go down lower, so they keep open their position. So in this kind of situation, does this have strength? Yes. Okay. Then the next one, when the price go down, the volume go down, and the open interest also go down. So this one also, the strength is reducing. So in the summary, what do you see? You see that whenever the open interest is up, that means this particular contract is gaining momentum. A lot of people are interested in this particular month's contract. However, when this month's contract, you see the open interest is reducing, and then the next month's contract, the open interest is increasing, you know that people are closing this month and then going to the next month. Okay, so for a trader, we always say that trend is your friend. For being a trader, you have to always follow the trend. Okay, you follow where the market is. Okay. Then the next one, why do we trade futures? So I'm going to talk about the three benefits of trading futures. The first one is the leverage. So as you can see that leverage means borrowing, okay? Ability to make large profits for a relatively small outlays of money. So small changes in price can make huge gains or losses because you borrow money, so you only need to pay a little bit of upfront, and then while you can still buy the same contract. So for example, we have a spot market. So let's say this is without borrowing. So that means in the spot market, the price of the CPO is 2,200 per metric ton. And let's say you want to buy 25 metric tons of a CPO. So your cash outlay will be 2,002 times 25, which is 55,000. Okay, so that means assuming you do not borrow money and then you want to buy the crude palm oil for this futures contract, you have to pay 2,002 times 25, which is 55,000 ringgit. Then the price increased 50 ringgit and you can make a profit of 1,250. And what is your profit? Percentage of a profit will be 1,250 divided by your capital 55,000, which is 2.27%. So this is without borrowing. So let's see another example with the borrowing. Okay, so with the borrowing, let's say you have this futures contract, FCPO is 2200, and then you long one contract. You long one contract, and then the margin you need to pay is how much? It's only 4,000. You don't have to come up with 55,000, it's only 4,000. And then when the price increased 50 ringgit, it becomes 2250. And how much you will get? Your profit will be, because it will be times 25. So for the 50 ringgit increase, you have to times 25, which is 1,250. So the percentage of profit will be 31.25%. So you can see that because of the cash outlay is very small, 4,000 only. So that's why you are able to have a larger gain. Okay. So the margin pay is only 4,000. So our leverage is about 13.75 times leverage. Okay, the next benefit of having to trade in this futures market is that we have a two-way trading. So that means if the market is going up, you can long or buy. If the market is bearish, going down, you can short or sell. Although in our Bursa Malaysia, the equity market, we can also long and we can also short sell. However, the short sell, it has to be done, recover, buy back within a day. So whereas for this futures market, you do not have to buy within a day. You can as long as you wish. So that's the flexibility. So, and if you notice, when the market is dropping or falling, the speed of dropping is faster than the speed of rising. Okay, so usually people, when they short, and then if it's a bearish market, the percentage of the profit is much higher than long. Okay, then so for example, you buy one contract at 2,600, and then you sell one contract at 2,620. So that means you make how many points? 20 points. So 20 points times 25 ringgit will be 500 ringgit. Okay, so this is 20 points of a target is a normal profit target for a swing trading. Okay, so then the short sell, if let's say you sell a contract and then the price dropped to 2610, from 2620 drop to 2610. So when the price drop, is it good or bad for you? If you short the market, it is good. So then your profit will be 10 points times 25, which is 250. Okay. So next is the hedging. The advantage about buying into the futures market is the hedging as well. So for example, just now we talked about the hedging for the crude palm oil, right? The farmers and the palm oil refinery. So how about if you own some stocks, some big cap stocks? And these majority are the top 30 component stocks. So if you own top 30 component stocks, perhaps you want to hedge your position with buying the futures contract. It's shorting the futures contract, because the equity market, you already buy those equity positions. So in the futures market, you have to short the futures contract. Okay, so this is to protect the price from falling. When the price is falling, at least you can make money in the futures market. So this example, we can see that the price is from the 1st of October to the January of this year, January 6th. The percentage change for these stocks are these percentage change, and then the value of portfolio reduced. So all in all, reduced about 9%. So your portfolio has reduced to 41,890. Okay. So you lost in your portfolio is 4,000 ringgit plus. So now what happened if, let's say, you short the market at the same time, also on the October 1st, okay? Because you see that suddenly you have this feeling that, oh, the market is not stable, and then I have such a large position in the equity market, and then what happened if the stock market collapse? What happened? So in order to protect my position, I better short one contract in the futures market. So you can short one contract in the FKLI with the initial margin of only 4,000 ringgit. However, you cannot short, if let's say you want to short the current month, the next month you have to keep buying the second month, keep shorting the second month, okay? Otherwise, you can straight away buy into the third month. So in this example, let's say you buy, you short one contract, and then the price dropped to 16, the index dropped to 1674, from 1795 dropped to 1674. Okay, so that's our KLCI index drop. So then our FKLI also dropped as well. So our FKLI dropped from 1795 to 1674. The spot market may not drop exactly this price, but let's say this futures market, it dropped like this, okay? So the gains from the futures will be 1795 minus 1674 times 50 ringgit, okay? That will be 6,000. So you lost from the stock portfolio is 4,000, so you have a gain of 1,860. So this is just an example, okay? So, okay. So far, over here, up to here, we have been talking about information about this futures contract. Why do we want to trade futures? And then the background about futures. Okay, but we haven't gone into the execution of the futures contract. So if let's say you are new in this industry, in the futures market, and then you are eager to learn about this futures concept, I hope that this 1 hour webinar, you can learn something, and then maybe you can have a bit of a confidence in this futures market. Because I've been investing in the stock market for more than 20 years. However, in this futures market, I've been trading for about 6 years. Okay, so for me, I would consider myself as a new comer in this market as well. So, however, through the 6 years, I have learned a lot, and then I have the tendency to trade in this futures market, and I think that the futures market is very liquid. So I will allocate a part of my portfolio. For example, I have 100% of a portfolio. Maybe I will allocate like less than 10% of my portfolio into the futures market. So then I can have diversification. And then also my long-term, my portfolio in the equity market is a long-term position. So every month I will go in and buy some of the stocks from the equity market. However, for the futures market, I will treat it as a short-term portfolio for myself. So I will trade like on a daily basis or on a weekly basis. So the money that turn out from the futures is a bonus to me, because sometimes if you are very good focused, you can make, you can have 10 to 20% per month. So that is a very good month. Okay. However, of course, there will be some losses. So on the average out per year on an annual basis, if you can maintain 10% of return, that will be good. All right. So next part of this session, we're going to look at the execution. I'm going to introduce to you what are the order type. Okay, take a deep breath, and then we're going to do the next session here. Okay, so say, for example, after today's session, you open an account, okay, tomorrow, and then they will give you password and ID, login ID, and then you can trade online. So then you come to this platform. So this platform, you will have this screen. Okay, so let's say you are looking at, because you are familiar with the equity market. So for a start, maybe you want to trade FKLI, which is a KLCI index, because you are more familiar with KLCI index. So you look at this screen, and then you can see that you have important. I will mention the important keyword. The important keyword is this last done, the buy price, the sell price, and then the open interest, the volume, and then day high, day low. So these are the important information when you look at the screen. So for example, in this case, you look at this is a February 7. Okay, when I prepared the slide, it was February 7. So I screenshot the screen, and then I put it here. And then you can see that for that day, the last done was 1689.5. Okay, then the buy price is 1689 and the sell price is 1689.5. So it's 50 cents above, 50.0.5 above the buy price. Because remember just now we said bid and offer. So this is buy price and this is sell price. So buy price is always lower than the sell price. Okay, because if you want to buy, of course you want to buy lower, cheaper. If you want to sell, of course you want to sell higher and more expensive. So that's why you have this buy price at a lower price and then sell price at a higher price. Okay, then the last done. Now, over here, what this tells me is that my last done price is my sell price. So what does that tell you? So that means the people, the person who do the last contract is actually buying from the seller. He buys straight from the market, which is 1689.5. He doesn't want to wait. If you want to wait, you can wait at 1689, and then you will have 7 contracts waiting together along with you. So if let's say you do not want to wait, you jump to this one person who is willing to sell only. Because over here you can see that only one person are willing to sell. And then over here you have 7 person or 7 contract waiting to buy at this price. So if you are very eager and you look at the market, it's going to go up. So I'm scared that I cannot get the contract. So I quickly jump into the market and then I buy at this 1689.5. So what can you tell in this kind of market with this simple information? So with this simple information, this straight away tell us that this market generally is having a bullish sentiment. Okay, that means the market is bullish sentiment, and then the buyers are willing to pay extra, something higher, okay, just to get it done immediately. Okay, so so this is the futures trading terminology. When you, as a starter, you have to get yourself familiarized. Then how you want to calculate your profit and loss? So say, for example, you buy at the 1689.5, and then the price, which is according to your expectation, rise to 1693.5. Then you gain 4 points. 4 points is 50 ringgit, is 200 ringgit. So that's a good gain. So some people, if their target is 200 or 100, maybe the rest of the week they don't have to trade anymore because that hit their target. Then if let's say let's say you decided to buy at that price 1689.5, however the market go against you and then it dropped to 1685.5, so you lost 4 points. So remember, futures trading is always double-edged sword. So it can go this according to your way, or it can go the opposite direction. So there's a risk involved. So you need to manage your risk. So in this case, the minus 4 point is a loss, and then you lost 200 ringgit. So you can gain 4 points, and then you can lose 4 points. So the position, you can tell that it can be quite risky, okay, if you do not manage your risk well. So the keyword is to manage your risk. Whatever we do always involve risk. It's whether we know how to manage your risk or not. Okay. So the margin call. So let's say give you an example about a margin call, because sometimes if you are new, you are afraid of having a margin call and then you do not know what to do. So for example, 1st of March, you set up an account and then you put in 4,000 ringgit to buy a contract, and then you buy a 1750 contract, and then the price the immediately after you bought, the price didn't go down, it went up 10 points. Okay, so your position, if you do not sell, the position will be increased by 500 ringgit. And then, however, the next day the market go down. Okay, and then if you do not sell, the price, the position will be minus 15 points from your previous day position. So in that case will be 3750. So that day, end of the day, you will receive a margin call from your broker. Okay, they will ask you to top up within the next day. So that means if you do not sell, and then the next day the price go against you, you will go into the other direction, and then the price go below 1750. Remember, you bought at 1750. Then if let's say the settlement price is 1745, so that means 1750 compared to 1745, you are actually, you lose 5 points. So that 5 points is 250 ringgit. Okay, so and that will be your margin call. Okay, understand? So as you go along, try paper trading. Okay, try paper trading, and then you'll be familiar. Okay, next we look at the order types. Okay, so there are 3 types of orders. You have the market orders, limit orders, and the stop orders. So the market orders, which is what I said just now. So for example, okay, let me test you. For example, we have this contract. Okay, the FKLI May 19. The bid price is 1750, and the offer price is 1751. Okay, let's say Mr. Lee wants to buy a FKLI at a market price. What do you think will be the price executed? So that means this Mr. Lee, he is very eager to buy. Okay, he just want to get it at the market price. So what do you think will be the price transacted in the end? The answer is yes, 1751. Most likely this will be the market price that will be transacted. Okay. Okay, next, limit orders. So limit orders are placed for 2 reasons. You can initiate a position or you can close the position. So a lot of us, most of the orders, 80%, I would say 80% of the orders are limit orders. So I always do limit orders. So that means what? That means I will key in a number, key in the price, okay, at your specific price. So for example, the market is 1720, let's say 1720. And then you want to buy a long futures contract for the FKLI. So then, however, the last one is 1721, let's say. So however, you do not want to buy at 1721. You think that the price will come down. Okay, you just want to queue. So therefore, you key in a price. Let's say you key in 1720. Okay, maybe I'll write here. You key in oops. Okay. Great. Okay. So, say for example, you want to buy at a limit price. Okay. So let's say you want to buy at a limit price, and then the price is 1720 compared to 1721. Okay. So if you want to initiate a limit order, what will be the price? Okay. So maybe I should show you this example here. So this is the example 1750, 1751. So let's say you want to have a limit order. So the limit order, in this case, what will be the price? Yes, it will be 1750 because you want to queue at this price. Although the last time may be 1751, or it could be 1750, or it could be 1750.5. However, you key in a specific number, and then this price will be according to your specific price. Okay, so this is limit order. You can do one example, because if you're talking about the KLCI index futures, right, the daily range could be plus or minus 10, 15 points. Okay, so that's a norm, 10 or 15 points. So for example, you open the market and then you want to test, okay, just want to test the market. So the market may be opening at 1750. So you just throw in a limit price at 1740, 10 points lower. Okay, you throw in a price 10 points lower at 1740, and then you wait for the volatility, because the price will move up and down, move up and down. You wait for the price to come down to 1740. And you see whether you got the chance to hit that 1740 or not. You can do this as an example, okay? Sometimes it may hit, sometimes it may not hit, okay? So it depends on the situation. So this is one example whereby you just key in one very low price and then waiting for the price to hit, okay? And then when it move up, then you sell. So that's one example. So if let's say Mr. Lee wants to sell at the limit order, so what would be the price? It will be 1751. Okay, so very simple. So the limit order is the most simplest one. Stop order. Okay, stop order, you can either limit a loss. The word stop, you see the word stop is already understood. Okay, that means you want to stop loss. So in an open position, it goes against you and then you want to stop loss. Or it can be using as an initiate a position. Okay, let's look at the limit loss first. So for example, you long this March contract at 1775. Target profit is 10 points and then you stop loss 5 points. So stop loss 5 points meaning what? When the price go down to 1770, it will automatically cut loss for you. Okay, so in this case, let's say, so that means you key in, after you key in the limit order, after you key in the limit order 1775 and then you got this at 1775, and then the market immediately after you got your contract at 1775, right? The market did not go up, but it went down further. So it went down and then you scared that it may go down a lot. So you quickly key in another order, contingency order, another order is called the sell stop order. Okay, on the screen you can key in, look for the sell stop. Okay, sell stop order, and then you key in the price that you want to stop loss. So you stop loss at 1770. So when the price move down from 1774, 1773, 172, 1771, 1770, then it will hit trigger the order, trigger the order, and then you will cut loss at 5 points. Okay, for that contract. So market falls and then you're protected. Okay, market fall further, but you are protected. So your loss will be limited at only 5 points. So the reason why I want to show this chart is that when you trade FKLI futures market have your futures chart. However, because the underlying instrument is the KLCI index, so you need to go to the KLCI index to see the bigger picture first. Okay, so this is a KLCI index, and then let's say you look at the index, and then there is this after the election, there's this big drop. Okay, and then you can see there's a very clear chart pattern here. Okay, this is multi-top chart pattern, and then the neckline is 1811. The neckline is 1811. Okay, then this particular day, the price closed below 1811. The price closed below 1811, and then you look at the chart, and then this give you a opportunity. So that means, say for example, if that is the case, you know that if this is going to happen, right? Most likely, this the next few weeks or next few days is going to be a bearish market. So then you can immediately short over here. Okay. However, if let's say up to this point, you do not know what's going to happen after election. You still knew there's a new government, so you don't know what's going to happen. So then, let's say you see that, oh, it is going to come down below the 220-day moving average, and then you are looking at such a big top chart pattern, a major multi-top chart pattern. So you are worried that what happened if it break down below the neckline, and then it will have a further downtrend. Okay, so before it break below this neckline, perhaps you want to trade order called breakout. Okay, you want to trade this breakout order. So that means you can do one stop order as well. So you can actually do this stop order. So this stop orders is called initiate a position. Okay, so So that means this stop order, you can have two types, two scenarios. One is to stop loss. The other one is to initiate a position. And this initiating a position is called, usually it's during the breakout scenario. So when the market is coming down and then coming to a chart pattern, and then it's going to come down a lot. So it's going to have a breakout position. So you can key in first, okay? You can initiate this stop loss, stop order using key in stop order, and then you key in the 18, maybe 09. So when the price hit below the 1809, you will trigger that order for you. Then you will log in as a short order for that particular contract. Then as the price go down, then you will make the money. Or you can do as a positive breakout. So you see that it's a double W, double bottom W chart pattern, and then you see that it's going to break out the 20-day and the 200-day moving average is going to break out. So there could be a breakout position. So then you can key in this stop order as well. So key in the stop order and then key in the price that you think it will break above, key in, and then it will be there running, and then until it hit that trigger that number, then it will log in for the price for you, the order for you. Okay. So this is called the stop order. Actually, not many people use this one. So let's do a summary on this order types, because when you are into this futures trading, you need to know the order type so that you don't buy into the wrong type of order. It will affect a lot if, let's say, you accidentally key in the wrong order. Okay. Then you look at this. So if, let's say, you are looking at the sell limit, the left hand side will be the sell limit and the buy limit over here. Okay, so sell limit and the buy limit is very simple. It's a majority of us, we are doing it. So we key in a low price and then waiting for it to go up. So let's say we key in a low price and then it hit the low price, and then immediately we key in a very like a 10 points target price or 5-point target price, because to you, you say, okay, I want to make 250 ringgit for that day. So you key in a 5 points target price. So you enter a sell limit. Okay, and the sell limit. So for normal, we enter a buy limit, a particular price, and then we close the position, and then we enter a sell limit at a particular price. Understand? So this buy limit and sell limit is for the most common types of order. However, when do you use a buy stop and a sell stop? So the buy stop is when you want to short the market. Okay, you want to short the market. However, the market is very bullish. It went all the way up. So then you quickly have to use a buy stop, okay, to stop loss. Then when do you need to sell stop? So when you want to buy at you think that the market, you want to buy low and then you think the market will go up. However, it didn't go up, it went all the way down. So immediately you want to key in a sell stop order to protect your price from dropping further. Okay, so this is the 4 types of orders. Okay, let's say we have the spot price 1689. Okay, so this is February 7. February 7, we have this contract. Let's say we have 2 contracts, which is a 2 months contract. One is February, one is March. Okay, February and March. So for February, we have 1689.5, and then this is whatever pricing. So let's say on this day, this particular day, you want to buy into the futures contract, and then what should you do? So first, you have a series of steps to take note. So you must have a trading plan. So this trading plan will start with the first thing, determine either you want to long or short. How do you determine? You look at the chart here. Okay, let's say this is a chart for that particular day. You look at the spot market. Spot market will tell you the overall picture first. Then only you look into the futures contract technical analysis. And then when you look into the future contract, you are looking at the 5-minute charts, the 15-minute charts, and the 30-minute charts. And these are the technical analysis belong to that particular month's contract. Okay, then and that one you have to is meant for your execution. Okay, however, if let's say you just want to know whether you want to long or short a big picture, right? You go to the spot market. You go to the spot market and you look at study the chart. So this is the chart. So the chart tells me that on that particular days, on the February 7, our KLCI index, although it's a black bar, however, we are still supported by a 20-day moving average. This red line is a 20-day moving average. However, do you see my trend line, this 45-degree trend line? Usually I will draw a 45-degree trend line. And in order to know what is the slope of this trend line, you go to the previous slope. Then you use this slope and then you move to this position. Then you know that when it will break. So in this case, it has broken below the trend line. So once it has broken below the trend line, it means that the trend is weakening. The trend is weakening. However, it is weakening, but it is still supported by this 20-day moving average. So in this kind of a situation, the market is kind of undecided. Okay, so given this scenario, what should you do? Okay, go back. Do you want to long or do you want to short? Okay, you can actually for this you can do a spread, because when the previous lesson you heard about spread is when you can long and short at the same time. So this was covered previously, so I'm not going to talk about it. So you can do a spread in a horizontal manner, or you can take a long position, because as long as it is above the 20-day moving average, you can take a long position. However, the target profit, maybe you want a lesser target. Maybe you don't want to have 10 points target. You just want to have 5 points target. Okay, so that can be adjustable. So your target profit may be lower because of that situation. You know, it's a horizontal market. And then the time frame. Maybe because of this horizontal situation, you don't want to keep in the market for too long. Maybe 1 or 2 days will do. Okay, so the time frame, you set the time frame. Is it the daily or 2-day kind of thing? And then which month contract? Usually for the KLCI, FKLI, we use a current month, which is the February. However, when it comes to the 21st of the month, then usually we'll go on to the next month, March. Okay, so then the target profit, stop loss. So in this case, the target profit maybe will have a 5 point, 10 points kind of thing, or 8 points or 7 points. Then the loss will be the 20-day moving average. It has to be 20-day moving average. This is a stop loss, slightly below it. Because for, however, definitely when we are looking at this futures market, we have to refer to the technical analysis of that futures contract. And then, so similarly, in that futures contract, we have to draw this line, okay, the trend line. And then we have to see whether it break below the trend line. Once it break below the trend line, you have to be careful that the trend is weakening. Okay, so when it comes to the technical analysis, fundamental analysis, and that one will be covered in another webinar. So that one, maybe I will show you the 5-hour chart, the 15-hour chart, and the half an hour chart, and then you can see how they move. Okay, so then, so what have you learned today? Okay, so today we have learned what is the future contract, basically the general, then what are the types, and then the popular ones in our Bursa Malaysia derivatives are the FKLI and the FCPO. And then who are the market participants? Majority are the speculators. Then why trade futures? Because of the leverage, you can gain more. And then perhaps you can, certain people will do the hedging lah. Because for the equity, if you have equity, usually you will not hedge the futures market. But if you wish, maybe you can hedge for one contract only. You don't hedge to take a large position in the futures market. I would not advise you to do that, okay? Because for futures, time is your enemy. What do you mean? What do I mean by time is your enemy? That means each contract has an expiry date. Okay, so when you buy, the minute when you buy into the futures contract, right, the time is ticking. So it's your enemy. Whereas when you are in the equity market, the time is your friend. If you buy into a blue chip stock, you just hold it for 10 years or for long, and then the dividend alone can recover your capital, because if you are talking about 7% or 6% kind of dividends. So it's different, okay? Trading in the stock market and trading in the futures market is different. So that's why when you're trading in the futures market, you will find it very lonely, because you cannot share your trading strategies with your friends, because everybody is your enemies. If you share with them your secrets, then they will copy you, and then you have no more advantage, no more edge. So a lot of time, dealing in the futures market, you have to be secretive, and then humble, and then down to earth and low profile. Then you can survive for a long time. Okay, then we also learned that the order types. Okay, so yeah, I think that's all for today 1 hour. Yeah, is it 1 hour already? Yeah, it's 1 hour.
Yes. Thank you so much. Yeah, Pauline, your wonderful sharing on futures. Now, do you have any question? If you have any questions, you may write it in the question and answer box so that Pauline will be able to help you to address some of your questions. Okay. Now, the first question we have on our screen is, do you have any good books on futures that you can recommend them for reading, or any YouTube videos on futures that you can recommend?
Okay, sure. The book that I read so far for when I was in this as a starting to learn about futures, I read the book called the Trade for a Living. Have you heard about Trading for a Living by Alexander Elder? So this book is a very good book because the author, he really talk about the psychology of investing. So you have to be humble when it comes to when you come to trading, and cannot be overconfident. Okay, so this is one book, and then another book is by the Elliott Wave. Perhaps you want to learn about Elliott Wave for the technical analysis, and also the Guppy Trend Trading, and the Market Wizard by Jack Schwager, the Market Wizard. Okay, and technical analysis. There is one author called Pring Martin, and he wrote this technical analysis book, and that one is for the like a theory textbook, kind of for technical analysis textbook, and which is good also for beginners. So these are the books that I would recommend. And for YouTube, I will recommend you to watch my YouTube because I do share how to trade in the YouTube channel. Yeah.
I see.
Okay.
Okay. So would you be able to reiterate what's the difference between derivative and futures?
Okay. Derivatives market is the derived demand. So this futures contract is under the derived demand, which is this subcategory. So you can see this derivatives market as a whole market that has all the futures and options listed. And these futures and options, all of them has an underlying instrument, and this underlying instrument is in another market. So therefore, this derivatives market or the futures market is actually, you are referring to the same thing. They are in the derived demand. That means they have, all of them have an underlying instrument. That means their price performance depends on the final product demand. Okay, so this is what you call derived demand. The price fluctuation depends on the demand and supply of the final products. Okay.
I see. Okay. So how do I make an account for future trading if I already have a CDS account? So that's the next question.
Yeah, you need to open another trading account. You need to open another brokerage account. Okay, so the one that you have, the CDS, is for equity market, so it's different. So remember, I said we have two exchanges. One is the Bursa Malaysia stock market, and the other one is a Bursa Malaysia derivative market. So that's a futures market. So you need to open another brokerage, and the license are different. So the remiser for the equity market and the remiser for the futures market, they are also two different licenses. So they are two different bodies. So you need to open in another brokerage account, or they call it the futures brokerage account.
Yes,
You can Google.
exactly.
Yeah, you can Google from. Yeah,
Okay.
you can Google from the internet to see what are the futures brokers available for Malaysia.
Yeah, in fact, if you go to bursamarketplace.com, you'll be able to see which are the futures broker.
Okay. Yeah.
Yeah, would you want to show them how to find the
Sure.
broker?
Yes.
Yeah, you just go to the.
Wait. So for this Bursa marketplace, is a very informative website. Over here, actually, I wanted to show you, this is a place where you can trade a virtual futures, so paper trade. So for example, if you are very scared of the real money trading, right? So you want to trade virtually. So this is a place. So you go to the Bursa marketplace and then you log in. Okay, you have to register and then log in, and then you go to this futures. So you can see that over here in my portfolio, I have this 5,000 plus. This was a portfolio that I did last year, whereby I short the KLCI and then the amount of money that I made virtually on paper. Okay, and then also for the brokerage, you can actually Google from here. Okay, you can Google and then see what the broker. Okay, anyway, you can Google yourself. It's you can explore this website. It's very useful. Yeah.
Okay,
Mm.
let's look at the next question is what underlying chart we use to trade FM70?
Underline chart. Oh, okay. No, I wish I would open up my okay. Actually, I need to open up. It's called the index, you know, the 70. Maybe I go to Bursa because I didn't open up my software.
Yeah, trading
Okay,
software.
over here, right? Did you see we have all these index and all these index, right? Like FBMT 100, all this BM 70. Now this one, each of them, they have their individual chart also. So if you subscribe to a broker and then they provide you with the chart, you can see the charts for FBM 70. Just as you can see your FKLI. Exactly. It's just that this chart will have to follow the 70 mid-cap stocks in our Bursa Malaysia. And this actually is more volatile than the KLCI index because KLCI index is the large 30 cap stock and they are very stable, the price. However, this FBM 70 can be more volatile than the KLCI index. So and the brokerage is much cheaper also. I think it's about 2 ringgit for the FPM 70. And then for the FKLI is 15 ringgit per contract. And then the FCPO is 16 ringgit. Oh, sorry, the FM 70 is 5 ringgit per contract. Okay, it's cheaper.
Yeah, it's meant for the smaller trader.
Yeah, smaller trader. And the contract per contract is 900 or one. I can't remember. It's about 900 or 1,000. It's much smaller than the 4,000 per contract. It's cheaper. Yep.
Okay, so let's see. The next question is for hedging, what difference between shorting spot month, then rollover, and shorting the third month contract?
Okay, so because you are shorting the spot month, right? So that means at the end of the day, the settlement day, 31st of the month, then your price will be calculated, will automatically cut off. Even if you do not sell, right, it will automatically calculate it for you at the settlement date. Then if let's say but that particular day you lose or you gain, it will calculate that, consider you as a closing a position. Then the next month you have to key in the new order to initiate a long order for that the next month. So even if when you key in the long order, you need to involve the brokerage charges. So you need to pay extra for the brokerage fee. And then when it comes to the end of the month, it will, if you do not close the contract, if you close the contract, you will have to pay for that brokerage fee. However, it is closing at the settlement, then you will consider close as well. And then the third month, you will have to initiate another open position. So in the sense that you will incur more brokerage charges. And also when you come to the second month, sometimes your emotion and everything, you may not be able to place that long order because of your emotion. Okay, so however, if you go straight to the third month, then you don't have to worry about the expiry date. You don't have to keep on initiating a new contract for each month. Do you understand?
Okay. So the next question is, with regards to open interest, is it always highest in a spot month? Do we compare the value with previous days in order to make sense of the interest in the contract that you mentioned?
Yeah. So for example, you are looking at the FKLI. So for FKLI, it's always the highest in the spot month. Okay. However, if you are looking at the CPO, it will be the third month, second month. Okay, it's the second month or the third month. So it depends on the beginning of the month or end of the month. So for example, now if you are looking at February, February is the first month, March second, and then April third. First, second, third, and then usually the second month is April, and then the third month will be May. However, you see that the May contract is more open interest, having a higher open interest because of we are coming to the month end. As we are coming to the month end, then the third month is a higher interest. So not necessarily it's a spot month. What I want to say is that not necessarily, depends on what product that you are talking about. If it's FKLI, it is the spot month is the highest open interest.
All right, excellent. So is it possible that if I fail to close my positions before the trading day and nobody want to buy or sell?
You mean trading day as in?
I actually don't really understand also.
Oh, unless you have buy into that contract, is nobody interested. That means the contract could be far month and calendar month is very far away. Then you initiate a long position. You initiated a long position like a long time ago, and then you want to close it. But however, nobody there's not liquid enough lah. In a sense, it's not liquid enough. So therefore, it is possible, because that's why you have to go for the highest open interest or the most popular high open interest contract. Otherwise, you may run into that situation. That means you can't find another buyer or seller to close your position.
Okay. Yeah. So is FM70 liquid to trade as the bid-ask spread is often 20 point? Now, how do we define liquidity in futures?
I haven't traded for the FM70, but I look at FM70 just the daily volume. The daily volume is quite okay. I mean, as for a start, it is quite okay. So I would think that FM70 it is gaining popular. Yeah.
Yeah.
So it is quite liquid. Yes.
Okay. So the next question is to compare day-to-day open interest after the master. I think this is the follow-up questions from the audience. So to compare day-to-day open interest after the market close or before the market open, is that correct?
Usually the open interest it's actually doesn't matter. We look at it as a big picture. I usually look at open interest as a big picture, whereby I want to know which contract. If you are having a glance at all the contract months, right? So your attention will be focused on those contract months whereby the open interest is among the highest, comparatively among the highest. So it doesn't matter whether you look at the market close or market open. It doesn't matter. So as long as you can spot that the open interest is a large amount of open interest, that means this month contract is still tradable. Okay, so you don't have to know either is it market closing or opening. It doesn't matter, because it keeps changing. Once it open, it will change all the way until it close. Yeah, the open interest will keep changing. Yeah.
Can you, I think this next question is, can you reiterate, I think the participant don't really understand about open interest. Can you reiterate open interest? Does it mean that, what do you mean by contract open?
Okay. See, for example, you long a contract, okay? You long a FKLI, you think that the market is going to go up, so you long one contract. So that means when you long one contract, your open interest in the market will increase by one. Okay, because you have already long one contract. However, if let's say you want to close a position, the market did in fact go according to your plan, and then you make some money, and then you want to close the position. So once you close the position, then the open interest will reduce. And you are just looking at yourself. How about another person, A, B, C, D? So everybody, they will buy and sell, buy and close, buy and close, buy and close. So some of them, they will buy and then they wait for a longer time, then they close. So as long as people are buying and selling, right, the open contract, the open interest will change accordingly. However, you want to see the big picture. The big picture is that you want to see a big open interest whereby people are still interested in this particular month's contract. So did I understand?
Yeah, I think you explained it fairly well. So the next question, let me try to understand what it means. All right, I will skip that question because I don't really understand. But is it necessary that open interest becomes zero when it comes to the maturity date?
Maturity date, that one I haven't really noticed. Yeah, I haven't noticed that one when it comes to the maturity date. It could be, I mean, yeah, it could be a zero because when the maturity, everybody have to close the position. Yeah.
Okay. All right. The next question is a little bit more sensitive. They're asking, what is your average return a year trading futures?
Okay. I started trading futures 2013. And along the years, some of the years when I get busy, then certain months I will not trade because when I'm too busy. So I noticed on average, right, if I can do well, I can perform like 20%.
A
Okay,
year?
20%. Yeah, a year. So that is actually not good enough because if you really focus, right, every month you can consistently make 5%, and then in fact you can make quite a lot of money if you really focus. However, because I couldn't focus, I'm too busy. So sometimes I have the problem of neglecting my trades. When I neglect my trade, then I will have a loss position. So certain years when I'm not so concentrated, then I do not perform well. But when I'm focusing, right, I can really perform. Yeah. So for futures trading, you really need to give your time and energy and then focus on your trade rather than get yourself too busy.
Yeah,
Yep.
forgetting your open position is very serious.
It's very bad. Yeah. I did twice, the mistake twice. Yep.
Okay. Hopefully next time you forget, right? Don't, wow, you make so much money. Okay. Anyway, the next question is like, how much forward can we trade for the FCPO?
How much what?
Forward.
How much forward?
I think maybe it's like
I see. 36 months. Oh, okay. Calendar months, right?
Yeah.
36 months. You can trade up to 36 months. However, the future advanced you can trade up to 2020, the year 2020 for the futures contract.
Wow, that is 2020.
Yeah, so I suppose that's for hedgers. I suppose that's for hedgers.
That is incredible.
Yeah.
Okay. So, right now you have answered all the questions on my on my list. So if you have any more questions, you can put it up there, and we will our speaker will address it shortly. If you don't have any questions, so let me just let me promote the next webinar. If I may take back the presenter control, Pauline.
Sure.
I'll make myself presenter now. Okay, wait. Let me copy the link for you. Okay, so for our next webinar, it will be based on Malay. Okay, so if you want to tune in to understand features from a Malay speaker, please join our next session. The the link is there. I just posted in the chat group. So the session is called Pengenalan kepada Konsep Niaga Hadapan. Okay, part 1, bahagian 1. Okay, 14 March 2019 is a Thursday. Okay, so the registration link is in our chat box. So, or if you have any Malay friends who want to learn what is future, so please share the link with them so that they'll be able to tune in and understand how they can use a futures contract to hedge their portfolio or to speculate and make some income. So this is will be conducted by a Malay speaker in Bahasa Melayu. So do you still have any other question? Well, I guess Pauline, you did a marvelous job.
Thank you.
Right.
I
So
hope they learn something.
yeah, definitely. Okay. Well, all right. I want to thank all of you. Oh, there are a lot of compliment message coming in. All right.
Thank you.
Yeah. Thanks, Pauline. Thanks, Shane. Okay. Now, I have one more questions. Yes, finally.
Mm.
Okay. Okay. This is also follow up from the question about open interest. Okay.
Okay. Yeah, I think a lot of people do not understand open interest. Okay.
Okay. Say the open interest for FKLI on day 1 is 40,000.
Mm.
Day
Mm.
2 is 36,000. Day 3
Mm.
is 41,000. Day 4 is
Mm.
39,000. So every day is different a bit. 40,000, 36,000,
Mm.
41,000, 39,000. So
Yeah.
do you think this will make sense, or you need a big difference to conclude that the open interest vary?
Actually, you look at the big picture. If let's say you are looking at 39, 41, this is considered a very good liquidity for that particular contract that you are referring. It could be the spot month FKLI or the third month of the FCPO. So if you are in this range of 40 40 to 50,000 open interest of contract, right? This is considered a good trend. So I would think that doesn't matter if it's 39, 41, a little bit different. But as long as you are in this range, right, it is considered healthy. So the trend is still strong. That means people are still interested in this particular contract. Yeah.
I see. All right.
Mm,
Great. So unless you see like 40,000, the next day is like 3,000, then something is wrong,
Yeah. So
Some,
suddenly it reduced a lot, then
yeah,
it's wrong.
not,
But however, if you are still within that range, so you're still okay.
okay.
But from 40 down to 20, that is something significant.
Hmm. Okay. Excellent. So, any more last questions before we close the floor for Q&A? Yeah, I think that no questions, no questions. All right. Oh, yeah. Thank you so much for tuning in, guys, and hope
Okay.
that this is has been a fruitful session for you. For those of you who are new to futures trading, I guess by getting some basic idea, you can do more research and try out the futures uh, simulation on the bursamarketplace.com. If you have not opened an account yet, please go to www.bursamarketplace.com. Go to their sign up a virtual portfolio, learn to do trading there, and try to long or short a few contracts, because that follows the real market movement of the FKLI or whichever contract it is spot month or future month. All right, so you can practice first and see whether you will be able to make a profit out of it. All right, so after you get the adequate education on futures, only that you open an account, that's where you really know exactly what it is, because risk comes from not knowing what you're doing. If you know what you do, have a proper education by following our webinar series, then the next time when you trade, you'll be able to ace, okay, in the uh, futures market. So for those of you who are asking where to join our April webinar, the April webinar link is not up yet, so we are just posting the March link. Okay, April webinar link, please follow us on our Facebook page, live chat Facebook page, or just follow Bursa Marketplace .com. In the event, Bursa event, there will be a April webinar link. Okay, so for those of you who are asking for the English session or Chinese session for April webinars, please stay tuned, follow our Facebook page, or you can also join me on my Facebook page, Shen Chu. That's where I share with you the futures webinar. With that, thank you everybody. Thank you, Pauline, for tuning in all the way from
Thank you.
Johor. Okay, thank you so much, and may everybody have a
Thank you.
pleasant rest of the day. Bye bye.
Okay, bye.